But I really wanted to do this session, especially after this week. And the reason why I want to do this session after this week is because I noticed firsthand, I saw a lot of traders were struggling this week. It was a very difficult week. For me, myself, it was a difficult week. I had, overall it was a green week for me, and for I'm sure many of you guys as well. But it was a week where myself, being maybe 2, 3 years ago, it would have been a really, really difficult week. And the reason why was because there were multiple days where I started off with a red trade. And the game plan for today is not going to be all risk management. I don't want to just sit here for 30 minutes and spit risk management out to you guys. I want to give you guys some fun stuff too. So we split this lesson up into two parts. The first part is going to be talking about managing risk, not just the normal risk management like you guys would probably hear from maybe a YouTube video or something else. It's going to be something different. It's going to be how I've learned to manage risk over time. For background, I'm sure you guys obviously know who I am, but I have been a trader for about almost 5 years now. I think about 5 years. It's been a long time, since like 2018-ish. And I started trading options, and the first year of me trading options was a very difficult year. I think I lost pretty much my entire account value maybe twice. And I was trading about 5 or 6K. It was a very difficult year. And for many people, your first year is usually the hardest. And then after your first year, you sort of create a system, right? You sort of have a system, or maybe you find someone else's system and you learn their system, and you want to learn more. And that's kind of where I was. I joined the chat about 6 months into my trading, and I wanted to see what other profitable traders were doing. And that's the first step you want to do as a developing trader. Is you want to look to see other real profitable traders. And what I mean by real profitable traders, I mean the ones that actually have proof of their profit and loss. Myself, I have multiple six figures of profit for this year. For last year, it was a little bit smaller. This year is one of my biggest years so far. In fact, I've already surpassed my P&L for last year in the first 6 months of this year. And I'm going to show you guys how I do that, not only by how I manage my risk, how I approach the market, like a sort of mentality, and I also will want to talk to you guys about how I increase my win rate. My win rate has increased substantially. I'm not the best trader. I'm not a perfect trader. In fact, I'm still learning, right? I still learn every single day. You guys have to understand too, like you need to find someone you want to learn from. In the chat, we have a lot of people to learn from. Mike, Unraveler, Felony, Aristotle. That's personally who I learned from. So people will ask me, Brett, where did you learn from? I learned from those 4 people. That is who I learned from, right? I joined the chat just like anybody else, and I learned from those people. And of course, what you do eventually is you learn from them and you sort of implement your own strategies. But the idea is that we all kind of are just doing our own thing in the market, and we're trying to find some sort of edge, some statistical edge. The edge is very simple for me. I trade 2 strategies, just like Mike and Ravel, Aristotle, Felony, Midas. We all trade pretty much the same strategy. It's either bounce and reject or the break and retest. Those are my 2 fundamental strategies. I'm going to break down a little bit about what it is, but I'm going to focus more so on the standpoint of price action. Today's lesson, you guys are going to have questions about other topics. I'm going to be going over things, and you guys are going to be like, well, Brett, can we go over that instead? Or can we go over this? I can't stray away from it. Otherwise, we will spend 5-6 hours today going over stuff. So I want to focus today about price action, right? Taking break and retest, taking bounce and rejects with the focus on price action. That is the primary focus of today. Particularly when I talk about price action, I'm talking about price action and breakouts. Part 1 is going to be managing risk, right? How I manage risk as a professional trader. And then part 2 is going to be increasing your edge by reading price action during breakouts. That's a game plan, about 15-20 minutes per part, maybe less or more, depending on how quickly we progress. How does this sound? Is everybody's ready to go? Everyone ready to get started? That makes sense? Okay, cool, awesome. I was going to ask you guys which part you want to start off with. As a joke, because I know everybody does not want to talk about managing risk. In fact, managing risk was the least voted for topic. Why that's the case? It's because it's the most boring, but it is one of the most important topics. And the reason why it's one of the most important topics is because people think that there is this magical system or strategy that allows you to be profitable. And yes, there are systems, right, that are profitable. I when I was trading regular break and retest, bounce and rejects, I maybe was like a 60% profitability. Um, and how I got to the 80-85% range was because I read into price action. Right? I created a system which allowed me to read into price action, right? Sort of added it to my system. So we'll talk about that today. But the point of the matter is that it doesn't matter what your system is, what your strategy is. If you do not have proper risk management, it does not matter. You can have the most incredible system in the world, and one or two losses in a row will completely destroy your account. And statistically, if you run the math on it, right, you could use a calculator. You can find out that if you have if you have a 80% win rate, give or take I can't remember the actual math on this, but every like 16 or 18 times, you're going to have a 18 trades, you're going to have a point where you take two losses in a row, right? It's going to happen, right? And the fact of the matter is that as a new trader, particularly for me as a new trader, I would come into the market, and I would size the same in every trade. Everybody says, hey, what's your normal size in a trade? Well, my normal size is 10% of my account or 20% of my account. That's completely wrong. If you guys want to be a real trader, I'm not talking about trading just maybe once a month or that kind of deal. I'm talking about if you want to be like a real professional trader, right? If you want to do this full time, you need to have a system to size yourself in each trade, an actual position sizing system. Game plan for the next 5 to 10 minutes, is to talk about a real position sizing system. It's deep. It goes deep. And the reason why I want to talk about this first is because I saw a lot of people mismanage, especially new traders, mismanaging how they size into trades. So that's the first topic. And the second topic we're going to talk about is rules for a high win rate system. Darius, no, it should not be 10% of your account. The reason why it should not be 10% of your account is because of this. There are three things I look for when I'm position sizing it, when I'm getting size in a trade. And this is, I know, trust me, guys, I know this is going to start off boring. We're going to go into more advanced stuff. The first 15 minutes boring. The second half will be a lot more interesting. Position sizing is a very important topic because people either undersize or oversize, and they kind of just size for the wrong reasons, right? It's more of just like a feeling, or they're just doing it off their gut. There is a very simple formula that you can use to size yourself in a trade, find out how much size you have in a trade. The first thing I do is I look at my confidence level in the trades. When I talk about these three things: confidence level, my contract expiration, and performance-based adjustments. Those are the three factors that I use for my system. And we're going to talk about those. Can you guys see my annotations, my drawings? Can you guys see this? I want to make sure you guys can see it. Can you guys see it? I want to make sure it's visible. Otherwise, okay, cool, awesome. So let's talk about that. The first thing I want to talk about is I want to talk about confidence level. So this is one of the most important parts about position sizing, right? Because some people will be like, "Hey, how do you know if you're full size? How do you know if you're full size or high conviction or whatever? I mean, how do you know whether to put on size or not to put on size based upon one, your confidence level? My confidence is dependent solely on two factors. What is the setup in play? Is it my A plus setup? You need to, as a trader, right, go through your last 5, 10, 20 trades, right, and find out what is a strategy that you find to be the most performing for you, right? For me, I have found that my A plus setup is this. It is this perfect scenario where you have a strong catalyst. Strong catalyst means this, right? You have an earnings, maybe like Amazon earnings play, or Meta earnings play, or even AMD earnings play. AMD was a trade we took this week, it was actually a loss, right? But a lot of these plays that have strong earnings, this is what I like to see. It's the first thing I like to see. The second thing I want to see is outperforming the market, right? So, for example, Amazon gapped up 9% after its earnings report. So this is a stock that is vastly outperforming the market, right? So when we talk about the idea of outperforming the market is SPY, right? SPY. And when you are trading in an individual ticker and you're looking for one to trade, well, Amazon's going to be probably my top watch. And the reason why is because while SPY moved up maybe only 2% on the day because it gapped up, Amazon moved up 8 or 9%, which that's a 9, 8% on the day. This is an outperformer, right? It is already outperforming the market. So the first thing I'm going to do is I want to look for these outperformers. And the easiest way to find outperformers is to go through and see what earnings reports there are on the day. If you find that Amazon reported earnings are up 8%, but let's say AMD reported only up 1%, well, screw AMD. I don't care about AMD. I'm going to focus on the stock that's outperforming the most. Other thing too, I focus on beta names. Beta names mean names that are like really big. They move the market. So your Apple, your Amazon, your Tesla, your Nvidia, those type of names. Names that are a little bit less known, right? Your non-beta names like Roku, DocuSign. Those would be your smaller names that I still would trade after earnings, but I would focus more on beta names. So beta name, strong catalyst, outperforming the market, and then look for a macro break and retest or a bounce or a pullback to a key level following its earnings release. This is my A plus setup. That's the first thing I do. And the second thing I do when I'm trading, doesn't matter what trade I'm in, what trade I'm watching, I want to see what the overall market is doing. So for example, if I'm watching calls at Amazon and I see that SPY just approached a demand, my confidence is high because we have the support of SPY. So I'm going to show you an example of Amazon in a little bit. I'm going to actually show you this in real time. Actually, you know what I could do right now? I could flip away from the screen for a second, and I can show you the Amazon chart. So let's go over to Amazon for a second. And Amazon, right? Amazon was breaking above a key tactical level at 142, right? At the same moment, if I were to jump over to a trade like, let's just go to SPY for a second. Let's open SPY. I want to go over to SPY and I want to look to see what was SPY doing at that particular moment. So SPY at the time when Amazon was breaking above its major retest level, which is 142, right? Well, you can see that at that exact moment, which is around 10:35 a.m., you go over to the SPY chart. What was SPY doing at 10:35 a.m.? SPY at 10:35 just broke and reclaimed 450, which is a massive key tactical level after holding the demand zone. It held demand, right? It held demand. It reclaimed 450, and it retested off of it, pushing up higher, clearing the key level on very high volume. Therefore, what is happening here? Well, what's happening here is Amazon is breaking out while the overall market is looking strong. Therefore, my confidence goes up. My confidence goes up. Therefore, I can put on more size in this trade. So not only do we have a strong catalyst, we have a strong catalyst, strong earnings, it gapped up. It's not pulling back my key tactical level, but we're breaking and retesting, right? Breaking and retesting my key retest level at the exact same time when SPY is very strong. Now, let's flip this for example. Let's just say that yes, Amazon was doing all these beautiful things, but you go over to SPY for a second, you see SPY was below 450, right? SPY was trading right over here at 449.80, right? Well, hey, that's not good because SPY has not reclaimed 450 yet. That's not good. It's that supply, right? That is not good at all, right? If you were to go back to the chart, you'd see, well, this at that particular moment didn't look very convincing yet, right? If I was buying calls at Amazon while SPY was retesting 450, and I'm not sure why I just paused like that. There you go. Okay. While I was retesting 450, well, that's not good, right? But because of the fact that Amazon was above my key tactical level and SPY at that very moment at 10:35 was fully cleared of this key level and reclaimed it, right? This made me more confident. So to go back to my PowerPoint for a second, let's go back to my PowerPoint. And I want to go back to my full screen. The two factors that influence my confidence level the most are going to be the setup. Like, what is the setup? Is it an A+ setup because it follows my system, my strategy, which is a macro breakout, a strong catalyst, breaking by a key tactical level? That's the first thing. And the second thing, what's the overall market doing? It's the first two things I look at for my confidence level. And obviously, right, the more confidence I have, the more size I put on, right? That's intuitive. So let's go on for a second. I want to go to the next slide. Everyone in the chat's doing well? Okay, cool. I saw a whole bunch of stuff in the chat. So everything, okay, cool, awesome. So the next thing I do is I also look at my contract selection. Just because I'm saying that Amazon is a trade I want to go full size on, doesn't mean I can come trade the same size every single day. Let's just say that same setup, which happened on a Friday. Let's just say it happened on a Wednesday. Well, on a Wednesday, I'm trading contracts that expire in 2 days. Whereas on a Friday, I'm trading contracts that expire that same day. So even though my confidence level was very high for this particular trade, right? I have a high level of confidence. It doesn't mean I can size into that trade the same size every single day of the week, right? Let's dig into that. So what I mean by that is that as you progress through the week, you're going to adjust your position sizing. This is incredibly important, right? This is incredibly important. This is, I would say, honestly, the first thing was the most important because it's confidence level. That's how I decide whether I'm full size or high conviction on a trade. But this is most important for new traders. Such a basic, extremely basic concept that everyone probably would understand after just going through it once. The idea is that as you progress through the week, right, whether it's 4 days to expiration or 3 days to expiration, so this would be maybe like on Monday or Tuesday, right? You're going to be your normal size, right? Your normal full size, which would be around 6 to 7%, 6 to 10% of your account size, right? And then as you are, getting later on in the week, obviously, let's just say Wednesday, right? Wednesday, you're going to be 1/2 to 3/4 your size, right? 5 to 8% of your account value. And then when you're 1 day to 0 day expiration, especially 0 day expiration, you're going to be very smaller size. So if I were to go into this, maybe on Amazon, I would have a 10K position here because my high confidence trade. I had my max size, and this would be 10%. And then maybe if it was on a Wednesday, I would have only about 7K of my position size. The reason why is because it's 8% of the max value for this. And then if it's on a Friday, 0 days to expiration, my max size is going to be 4K. The reason why this makes sense, it's fairly intuitive. Many traders who've been trading for a long time understand that as you get closer to expiration, right? Expiration being here, as you get closer to expiration, the contracts become more volatile, right? They become more volatile. Feet, right? For volatile. On a Monday, they're going to move less. On a Friday, they're going to move a hell of a lot more. So you don't need the same size to get the same profit or loss, right? If my max loss on this trade is $500, then I could have a 10K position on Monday, but then have only a 4K position on Friday, right? It matters the contracts you're in, right? It's very, very important. The next thing that's important is you're going to make performance-based adjustments. This is something I noticed some people doing as well. And this can be dependent on you as a trader. You can simply look at everything I'm about to tell you next 2 minutes and say, hey, Brett, this is cool, but I disagree with it. I want to do it this way. And that's totally fine. This is how I have sort of adjusted my risk. But you guys can sort of, play with it as you will. This is a scenario trade. So if my first trade is red, right? And I'm a normal size, my first trade, I'm going to progress my second trade also normal size. I'm not really going to make any adjustments. I may be a little bit more conservative where I take profit, but I'm not really going to size differently. And the reason why I do this is because if my first trade is red, let's just say I'm down $500, right? I'm $500 down in the day, which happened actually 3 times this week. I was down off the open and then ended up taking green trade. And the next thing you know, I was very green in the day because of the fact that I use a size system. So if I'm red in my first trade, I'm going to obviously have a little bit of a confidence loss, but I'm going to come into my next trade. And if that next trade is also red on my normal size, I'm going to be down about 1K in the day. This is usually where I end it, right? I usually stop it at this particular point. I'm not going to take any more trades. But what ends up happening here is that what happens for most traders is after one loss, after a $500 loss, they're going to come into their next trade and they're going to take a smaller position size. And this may be an A+ setup, maybe perfect trade, just like Amazon. And then they're going to be in very, very small, very, very light in this trade. And the issue with this is that even if this is a beautiful trade, you absolutely kill it in the trade, right? You only make, let's just say 20 or 30%. And you profit $300 on this trade because you're a smaller position size. Now you just took one red trade and then one beautiful green trade, but you're still down the day. Now you feel horrible still because you're still red in the day. This is an issue. So what I do for myself is I size normal on my first 2 trades, right? Normal size. If I'm red in my first trade, I'm going to come into my next trade with, maybe a little bit of confidence loss, maybe a little conservative with how I take profit, but I'm going to be my normal size. Now, a second sort of scenario would be if my first trade is normal size, right? If this is a normal size and it comes out green. If it comes out green, let's just say I made $700 in this trade. Well, my next trade is going to be half size. And the reason why I do this is because I'm protecting my profits. If I am $700 green in the day, right? $700 green. And then I come in and take a $200 loss on my next trade, which makes sense because my size is a little bit smaller. I'm going to be up $500 in the day with one green trade and one red trade. So the idea here is that this scenario tree makes it so I am best optimized for green days and my max risk is lowered for red days, right? That's kind of how I adjust my risk. And then this is a scenario if I take 2 red trades in a row. Basically, if I take 2 red trades in a row, I either stop out in the day, which is 90% of the time, or I size 25% of the time moving forward. And then I completely stop out after 3 trades. If I take 3 red trades in a row, that's it for me. I call it a day. I go do something else. then come back the next day with a clear head, right? I don't want to be taking more than 2 or 3 trades red in a row. That's simply just going to put me in a bad spiral, right? Because at this point, I'm going to go on tilt, right? I don't want to go on tilt. This is what I do to avoid being going on tilt, is just stop out after 2 or 3 red trades in a row. So let's move on. The next thing I want to talk about is daily risk adjustments. So if I'm green on day 1, I'm normal size on day 2. That's obviously normal, right? If I'm red on day 1, I'm half size on day 2. That's how I progress, because typically I have confidence loss. If I'm red on day 1, I'm going to come into day 2 being a little bit finicky, a little bit nervous, a little bit anxious. So I'm going to be half size on that day. And what's also important to do is define your max risk. So if you know you're getting in a trade, and you plan to be 3K size, right, on this trade, well, know that your max risk is probably going to be about 20% of that. So you have to do the math on it. You always have to define your maximum risk in a trade before you enter. I've seen far too many times developing traders come in and they trade 0-day expiration, right? Way overly sized on 0-day expiration on a trade that they should not be confident on in the first place. And then they don't define the maximum risk and they end up holding to the contracts hit 0.01, meaning they literally have become valueless. You can't do that, right? You have to be somebody who defines your risk appropriately, adjust your risk depending on your confidence level, and then lastly, adjust your risk depending on the contract you're taking. 0DTs being more volatile than anything else. Okay. Case example, this is the last part of risk management I'm going to go over, just because I'm spending way too much time on this. Case example, how do you properly define your size in a trade? So again, let's go over an actual case example of this. So is it my A+ setup? This is Amazon being my case example, right? Amazon is my A+ setup. Why? Strong catalyst, breaking above a key tactical level. It's my A+ setup. What is SPY doing? SPY just broke and reclaimed a key tactical level at 450, reclaimed it, retested it, and was moving higher. Very bullish on SPY. This is beautiful. So I'm confident on SPY as well. So I have 2 ticks. Then what contracts am I taking? Well, in this case, I'm taking 0DTE contracts, right? So I'm trading Friday expiration contracts. Well, this means I'm going to be my full size on 0DTEs. So my full size on 0DTEs is about 4 or 5% of my account value. Your percents can be a little bit different. I don't want to tell you, hey, if you're trading on a $500 account, 5% of $500 is very little. You can adjust your size a little bit on this. You can have leeway on your account side, on your accounts here. But this is how I do it with my account. My account ranges between around 65 to 75K. So 4 or 5% for me is going to be a 4K position size on Amazon. And that was the exact size I had on Friday on that trade, right? That was the exact size. I got in at over that 142 level, took profit at 143, made about 30%, made almost about $1,000 as I was scaling out in the trade, right? $4,000 my exact size list. And that's how I use my size system. You don't have to come in here with every trade. I want to make this clear too before I leave risk management. You don't have to write this out every single time you trade. In fact, for me, it's kind of like driving a car. I don't have to sit and remember, oh, is it 0-day? Is it 0-day? Oh, what's my confidence level? I don't have to ask myself that anymore. You're going to get to the point where it just becomes very natural to you. So you don't have to, write it out or do something crazy, right? You just have to keep it in the back of your mind that you are watching your size depending on these 3 factors, right? Depending on your confidence level, the contract expiration, and your performance-based adjustments, right? Those are the 3 factors that I wanted to go over. So, okay, now, before I move on to the next part of today's lesson, which is part 2, I want to make sure, is everybody understanding of position sizing? Does everyone understand how I size into trades, right? Why I choose my size? Does it make sense? Okay. Dexter, can you tell us why 142 is a key level? I want to keep today on a certain game plan, so I'm going to try to stray away from questions that go over that, but I will talk about Amazon in a little bit. I'm going to go over it in a little bit. Yes. Okay, cool. So if we have time today, I'm going to go back to talk about my trading rules. But what I want to do now is I want to get right into, actually, no, let's ask you guys, you guys want to go over my trading rules, or do you want to go right over to price action? Totally up to you guys. Do you want to skip over it, or do you want to go right to price action? Okay, rules. We'll go over rules. You guys like the boring stuff. It's fine. Okay. These are 9 things that I have, or 8 things in my trading system that I always use. Now, they're not all rules, just things to think about and things that like little principles. Always have a trading plan. Never just enter it because you think it's going to go up or you think this or you think that. That's not a plan. You're forecasting. I made the mistake so many times. I would think, oh yeah, Amazon's going to go up tomorrow because it's strong today. That's not really a plan, right? That's just I'm forecasting. A plan, a plan is this, right? A plan is this. A plan means you have a rationale, right? You have a rationale being okay, if Amazon clears above 142, it has nothing room to 143. That's a rationale. You have an entry price and the break and retest of 143, and you have a profit target being 143. You have a stop loss strategy being a break below 140, 180, right? So that's your stop loss. So you have your rationale, you have a price level, you have a profit target, you have a stop loss strategy, and your risk management is everything we just talked about. Your position sizing, how you approach the trade, all that juice, right? But this is what a trading plan looks like. So you need to have that down to a T, right? With every trade you take, you have to have that sort of mindset. Remember, I know it seems daunting to do it every single time. And again, right, you can just have it as a mental note. You don't have to write it down. For some people, it's important to write it down. But for me, I don't write it down. I just know it, right? I know my stop loss is here, my take profits here, and I'm entering here. Do not be emotional and impatient when a price is not moving in your favor. Give this that time to play out, right? You have to, if you're in over 142, right, on Amazon, let the stock play out, right? Let the play work, right? If it keeps you in, maintain your stop loss, maintain your profit target, hold the trade, right? Now there are certain times you can cut earlier, but you want to be as unemotional as possible, right? And do not be impatient. Chasing a trade is not good practice. Let it pull back. I don't care if Roku just had the best possible news at 1 p.m. I don't care. I want the pullback, right? I don't want to be the guy that buys the stock right over here, right over here. And the next thing you know, I'm in the trade and then it's over here because you guys have seen that many times before. I would rather wait for the pullback, right? Define a key level to look for a pullback area. And if it doesn't work, it doesn't work. But I would rather find a pullback area than try to just chase it, right? Now, if you're going to be chasing stuff, at least have a strategy to chase it, right? So if you're in a breakout, right, and you're getting starters in over here, right, at least have the intention to add more on the actual pullback, right? The idea is you don't want to be chasing. Without the proper risk management, even with the profitable strategy, you can be red overall. This week, I've seen it multiple times. Many of you I saw probably 50 people in the chat, right? And I'm not calling anybody out. It happened to me. It happened to me almost every single day when I was, developing as a trader. I took Amazon, right? You got many people took Amazon, and you made money from it. Then you came and took SPY, and then you took, I don't know, Roku, right? Something else in the day that maybe just didn't make sense to trade, or Tesla or something else. And the next thing you know, you're now right in the day. You need to, right? You need to have a real system where you manage your risk. If you are green in the day from Amazon, come into your next trade, just like we talked about, with half size. So then if you are red on SPY or Roku or Tesla, whatever it may be, you call it a day and end the day green, not red, because you were half size on your next trade. Remember, we do green trades in a row, right? Green trade one, I'm normal size, right? So maybe you made $500 on Amazon. And then my second trade, if I'm red on it, I'm going to be half size. So my max loss on this is probably 250, which means I can still walk away with 250 profit. So the idea is that you want to be managing your risk, right? And not jumping around trying to trade a bajillion things. But also, if you plan to trade a bajillion things, at least have a system. So you can feel comfortable that you're trusting a system. And if you're going to take 5 trades in a day, at least you're sizing down on each obviously trade that precedes itself, right? That's the idea. Next thing is you want to avoid averaging up. So something I never do, I absolutely never do this, and people can disagree with me on this one, but I avoid averaging up my contracts. I never, if I'm getting in on a Tesla bounce, right? And this is the bounce level, and it's coming right to my key level, and then I buy contracts here, and then it rips up, and I realize, oh man, this is really going to go. I think it's going to go, right? I think it's going to go to the moon. I'm not going to buy more over here. I just won't do it. The reason why I won't do it is because I won't add more contracts at a higher average cost. Because next thing you know, if it pulls back to my bounce level again, I'm now going to be net red in the trade, right? As opposed to break even, which I would have been at this point, right? The idea is even if it's slightly pulled back, even if it pulled back halfway, right? Halfway retracement to where I initially entered. If I enter here and enter here for my second entry, if it pulls back to here, I'm actually going to be red in the trade now. The idea is I don't want to, if I'm in calls, if I don't want to, I don't want to ever be averaging up my cost on contracts. I just don't do it. The sixth thing is scaling into setups at key tactical levels, right? You don't want to just have randomness. You don't want to say, I think Amazon's going to go up. You want to have a real system, right? If it breaks above 142, I think then it will go to 143 because that's the key level. Focus on trades that only fit within the criteria that works for you. It does not have to be the criteria that works for me. If your criteria is you use the RSI and the MACD, and that's what works for you, then that's your system, right? That is your system. Focus on what works for you. If it doesn't work for you, then don't trade it. If I'm green after 2 or 3 trades in the day, I'm usually going to walk away. Usually 9 times out of 10, walk away, right? I want to save my mental capital. I want to, not be depressed, right? I want to make my money and walk away, right? I don't want to just sit in the market and then take, 7 trades and sit there all day. The idea is you want to make your money and get away from the market. Okay, let's jump over out of this because the trading rule stuff really makes me tired. Let's go over our part 2. So if you guys are ready now, let's get started. Is everybody ready? Is everyone comfortable with what we just went over? The first part. Is everyone happy with it? Everyone kind of understands? Okay, cool. Awesome. A lot of yeses. Okay, cool. This is the most amount of you guys I've seen in any of these classes, almost 500 guys. So it's really, really cool. Okay. Cool. All right. Now, the second part of this is going to be more interesting. And remember, I'm not going into everything. In an hour's worth of your time, we can't cover everything. But what we can do is we can cover what I think is really important, which is increasing your edge by reading price action. We're going to talk about increasing your edge in general by reading price action, but we're going to focus on during breakouts in particular. So a lot of this is going to be during breakouts. Edge basically means you have a statistically higher win rate, because you guys will notice most traders, I mean, vast majority of traders, have a 50% win rate. It's really hard to see my writing right now because it's the same color as the background. But if I write over here, it'd be better. Most traders have like a 50% win rate, right? And the idea is if you have a system, maybe break and retest or a value reject, maybe you can get that to maybe 60%, right? You can have a slight statistical edge. Your edge here would be about 10%. That's your edge. How can you increase your edge? You increase your edge by doing smaller things. And the smaller things for me is price action. For some people, it's level 2. For some people, it's time and sales. For some people, I don't know, maybe it's like maybe like the moon formation, something. For me, it's price action. I focus on price action. So if I were to trade every single bounce and reject, every single break and retest, my win rate would probably be around 60%. And that's what it was. My win rate was hovering between 50 to 60% for like 8 months. And then I focused on price action. I focused on reading into price action and having the idea that I really want to be convinced on every trade I take. And this is very important. This is a very important concept. Price action, as you guys know, let me just get out of this, go to the next slide. You guys have seen this before. I've done a price action lesson before. It's a combination of 2 things. It's a combination of volume, representing the number of transactions that occurred in that particular candle. And then it's also the aggression behind the break. So what does that mean? First of all, let's talk about volume. This is volume over here, volume. Volume represents the number of shares transacted in one candle. Every candle is one increment of time. It could be this, if this were the hourly time frame, 1 hour, each candle would be 1 hour, 1 hour, 1 hour, 1 hour. And this would be how many shares were transacted. This would maybe, if the average here was 50K, then maybe this would be 55K. This would be maybe 52K. This would be 60K. This would be 70K, right? The idea is that I focus on volume on one time frame in particular. I focus on the 5-minute time frame. And why I do that is because as a day trader focusing on intraday movements, I use the 5-minute time frame. That's what I use the most. You could use other time frames, it would work. But this is what I find the best for me. And what I do, right, is let's just say a stock is breaking above a key level, right? Let's just say we're approaching a key technical level and you're seeing a breakout, right? But the breakout has, it's breaking above, yes, it just broke above. Let's say this is Amazon. It's breaking above 142, but it broke out on this type of volume over here. Well, if the stock price is going up, right, and the volume is going down horrendously, what does that mean to me? That means to me that buyers are not really there, right? Buyers are not really there. The buying aggression, the buying power is not really there, right? And the reason why is because at the higher average price of the stock value, there are less transactions occurring at the higher average price, which means that any small little bit of sellers that come into the market, right? Any new wind of sellers that come in will push the whole, the whole house of cards down. And that's why you see very sharp reversals sometimes, because you have very little buyers, then you have a very, even just a marginally larger wave of sellers come in, it's going to wipe away all of those bids, and you're going to see a very aggressive sell. So what do you do when taking breakouts? The first thing you guys know is you look for high volume, right? You guys probably know that, right? High volume. When is look for high volume breakouts like this? You want to see volume extending way beyond its average, not just beyond its average from that current day, right? The intraday. You want to look at the previous day too, right? Look at the intraday, but also look at the previous day. If it extends past its previous day volume, or maybe it's SPY, you're trading SPY, and you see that this candle, the average on the whole day was 100K shares traded per 5-minute candle, and you see one candle comes in at 1.7 million. Well, that's a particularly large volume candle. That to me would be high volume. And the second thing you want to do is you want to gauge the aggression behind the break. The aggression, let me just clear this all out. The aggression is known as the difference between the high and low of the candle. Some people talk about it being the wicks. You could talk about it being the body. The general idea is that the larger the break and closure over a key tactical level, the more likely it's going to go. So putting these two things together, right? The larger the volume and the stronger the break equals the more likely it's going to go, right? In either direction, the upside or the downside. If you were looking for a downside breakdown like this, right, and it was breaking down the downside, you want to see larger volume like this, right? And a large red candle like that. It's the same idea, just the opposite. The idea is that these two factors are what I look for more than anything else, right? When trading anything. So if I were to move on to my next chart here, this is what I mean about how volume affects, well, how to read volume with respect to price, right? Or vice versa. So if you're seeing that the price is rising, the stock value is rising, let's just say this is, actually, let's make this a better chart here. Let's just say here is stock price. So SP, stock price, and then this is volume, right? So two different charts on each one over here, right? And there's just two different charts. So if you were to make this a stock price that's rising, so stock price is rising, and you see the volume is dropping. Well, what that tells me, if you're seeing low volume red bars come in, right? Low volume green bars come in while the stock price is rising. Well, this is indicative of reversal, because any small wind of sellers that come in, it could completely wipe away all the bids, all the buyers that are there, because there's so little buyers, so few buyers there, that it could be a very sharp reversal. This is why I don't take breakouts on low volume. And if you see the opposite happen, right, we see the stock price is rising, but the volume is rising, this is indicative of continuation. So Amazon, for example, we'll go over in a second. High volume break, indicative of continuation. Then if you see price dropping, right, price is dropping now, but volume is rising, right? Volume is rising to the upside. Well, this to me would be indicative of continuation, right? Because you have more selling pressure coming in at these lower average prices. So people are continuing to sell, right? More transactions are occurring at these lower prices because there are more sellers, right? Especially if it's moving down. Then if you see price dropping and volume is dropping, right? So price is dropping and volume is dropping. Well, you know this is indicative of reversal, because if any small amount of buyers come in the market, well, this could lead to a huge upside reversal and a squeeze the upside, right? So the idea here is that anything with low volume usually means reversal, right? Usually means could be reversal, right? Not always reversal, but could be reversal. So anything with low volume, I avoid it, right? I want to see high volume, because that means conviction, that means confidence, right? High volume equals conviction, confidence. Low volume equals reversal. So if you were to carry that same ideology over to this chart over here, this is a SPY chart from Friday. I'm going to show you guys in the next 10 minutes or so. We're going to finish in about 10, 15 minutes. So hopefully you guys aren't too bored. But But next 10, 15 minutes, we're going to go over several charts. This is the first chart I want to talk about. And I just want to talk about the price action in a few different areas here. This is not the best example. We're going to go over some better examples in a minute, like actual trades that you've taken. But this is a chart here on SPY. And SPY, pushed up into a key level at 451.80, 452 with big supply. It faded it, went all the way back down to 450, popped up after holding demand, reclaimed its demand at 450 on high volume, right? That's the first thing I see here. It's on high volume, right? If you're trading anything, break and retest, break and reclaim, whatever it may be, this is what you want to see. It's the first thing I want to talk about. And it's not huge. It's not really important here. But the idea here, if you're seeing a break and you want to know, hey, should I go short or long? Well, you see us reclaiming, then maybe retest that retest level, right? That 450 key level, hold it on high volume, and we burst up to 452. Then we approach 452. And notice here for a second, this is a trade I actually had taken. I saw that we were stagnant for a very long time on very low volume. Then all of a sudden we broke out, right? All of a sudden we broke out here on pretty high volume, right? Pretty high volume. We broke out above this 452. And this was a high volume break combined with a high range break. You can see the range of this candle was larger than the last couple candles, right? It was a pretty decent break, especially this candle over here. So I knew that after this candle and this candle, we would go higher. And it wasn't a lot, right? It wasn't a huge trade that I had taken, but it was about 30% profit on zero day expiration. We pushed up higher and we came right into 453. And then we stagnant there for a while. Then we sold off. And what I want you to do now is this is cool, right? This is awesome. That's fine. It's good price action or a big clear above a key level, high volume clear, right? Particularly very high volume clear. Nice range over that key tactical level. And we saw continuation, right? That's beautiful. That's what you want to see. Same thing here, right? You see a reclaim of a key tactical level. You see a lot of buyers come in on that reclaim, indicating we go higher, right? So everything was telling us we go higher. Then the market completely shifted. And the market completely shifted on this candle right over here. And why did it shift in this candle right over here? And the reason why it shifted was because you'll notice that this candle, right, was the highest candle of the day, right? Since almost 9:30, it was the highest candle of the day at 9:30, or since 9:30, breaking below 452. This was an incredibly strong sell candle, one of the biggest candles so far on the day, very high volume over 452. In fact, I got in calls over here. I had taken almost majority profit over here. Then at this point, when I saw this crazy red candle come in, I was still in calls and I realized this is not the trade to be in anymore. And the reason why I realized it was not the trade to be in anymore was because of the high volume sell below 452. This was telling me the market was going to go lower. We eventually popped back up to 452, couldn't break above it. And we saw a very high volume sell candle come in, right? And a little bit of choppiness, then a big aggressive move down all day. This to me is clear price action. This is not really breakouts, right? This is just overall market price action from Friday. I'm going to shift over now and show you real breakouts, but I want you to get the idea here about what these high volume breakouts look like, low volume breakdowns look like. You can see when you have a high volume breakout, you tend to get continuation. And when you have a high volume breakdown, you tend to get continuation, right? And the thing that's also important here is understanding, right? Little side note here is understanding when you're wrong in a trade. I could have just as easily gotten in calls over here, right? Taken some profit off over here, then held my calls all the way to 450. But the reason why I got out over here was because I saw an incredibly high volume sell candle pushing us below 452, which is the highest volume in the day so far since 9:30, telling us we were going to go lower, right? And the important part about being a trader is not having an ego, is understanding, okay, market is telling us we're going to go lower now. So I stopped out. Moving on to our next chart, I want to talk to you about this chart. This is a chart you guys probably recognize. But this is you guys probably know it, but I want to ask you a question in the chat. This is the breakout, right? So you see the stock is consolidating under a very key level, right? Under a very key level. And then it is now breaking above a key tactical level. Let's just say this is 200 on Apple. Let's say this is an Apple chart, right? AAPL, and it's breaking above a 200 resistance. My question for you guys is, are you convinced in this breakout? Look at the volume. Look at the actual break of this key level. Is this a high conviction move? Yes or no? What do you guys think? Would you guys buy into this? No? So I would say yes. The reason why I would say yes The reason why I would say yes is because look at the volume, right? Look at the volume and then look at the break. We have a high volume closure over, right, over our key tactical level, right? And you can see, right, this is a particular, this, look at the red candle, right? There's literally no volume over here. There's no volume in the last 20, 30 minutes. Then we have almost a 20% increase in volume over a key tactical level. This is what I look for, right? I know many of you guys are going to say no, but we'll go through more examples. You guys will see it. So let's look at the next slide now. Let me clear out my drawing here. So it was like 50-50 in that one. Many people got it wrong. Let's look at the next slide, right? So you see this candle was not, I mean, you could have waited, or you could have waited for this candle to form, but you have a nice break over a key tactical level, particularly high volume, right? A good clean break. It pulls back down to your retest level, actually wicks up, forming a bullish pin bar, indicating continuation of the upside, right? And that was what we saw, right? Continuation of the upside. Now, at this point, right? At this point, we're approaching a major resistance on the stock. And yes, we're moving higher, but now you can see the volume is starting to fade out, right? And at this point, this is where I end up taking profit. You guys probably know this exact chart. This chart was from Amazon, right? I'm sad many of you guys got it wrong, but that's okay. We have some more examples to practice up on. So don't stress it. We have a few more, but this was Amazon. Now let me ask you another question. Let's go to the next slide. This is the retest. I did not take this retest, but now I want you to focus on not only the breakout. So you have a high volume breakout over a key tactical level. You can see the volume. You guys can see it too, right? How, when you see a trade in hindsight, it's so easy to say yes. But when you see it in real time before it actually had broken out, sometimes it's difficult to be able to read the price action appropriately. That's why it's important to read what it's telling us. It's telling us high volume breakout. Now look at the pullback, right? Let's focus on the pullback now. What do you guys notice about the pullback? The volume. Is it volume high or low in the pullback? Is it volume high or low? What do you guys think? Low, right? Some people are saying bear flag. Is this a bear flag? Not a bear flag. This is actually a bull flag, right? This would be a bull flag into a key tactical level. Some people ask, hey, I took the breakout at Amazon. How do I know if I can take the break and retest for the upside? Well, you can take the break and retest when you see low volume pullbacks like this. This is what I look for, right? We have a high volume breakout, right? I got in the retest over here. You could have come back in later in the day and seen that we pull back on particularly low volume, right back to our retest level, forming a potential bull flag for a move higher. The reason why I say that is because, again, you have high volume breakout preceded by a low volume pullback. This means sellers are not very strong. Now, if I saw a very high sell candle come in, maybe that was like this, right? I would avoid it, right? I would avoid the trade because I don't want to get stopped out by seeing a crazy red candle below my key tactical level. Because of the fact that we had very low volume sells coming in, right, as we're approaching our retest level, I knew that it was decent risk reward to go long for our move higher. So scaling the calls here, add more back at a retest level, which is 142. If you guys didn't know already, this is the Amazon chart, right? This is the Amazon chart, literally the same one that many of you guys had traded from Friday, right? And you can see the next slide, right? The next slide, let me go to the next slide over here for a second. And you're going to see what ended up happening was we got a nice juicy push back to high of day, right? The idea here is to look for stocks that are breaking on high volume, look for the retest on low volume. If you want to get in the retest, if it's coming with very aggressive sells on the retest, avoid the trade, right? You can even see it, right? Look at the buying volume coming in, right? Now that it has it actually found support, right? This is where some people would come in, they would see 3 red candles in a row and they'd say, oh yes, this is bearish now, right? Sellers are coming off a key supply. Absolutely not, right? You have very low selling coming in. Therefore, when any little bit of buyer comes in, it's going to slam the stock back to the upside. And we saw a big high day push. You could have taken profit and the rest and walked away. So actually on Amazon, there were 2 beautiful trades. The breakout, which was very beautiful, and the retest about 30 minutes later also worked very, very well. Now I want to jump to the next chart. And I want to ask you guys this time, right? And this, hopefully you guys get it right. Now look at this. This is the breakdown trade, right? So we're looking for a break and retest the downside. Is this a high volume breakout? Is this a high volume breakout to the downside? Yes or no? What do you guys think? No, it's not, right? Look at the volume, very abysmal volume. Look at the range of this breakdown too, right? Remember back at our Amazon example, right? The range of the breakout was pretty big, right? Compared to the last couple of candles. Look at the range on this stock, right? The stock range has been huge. The actual range is immense. The actual size of the candles are huge, right? And then look at the breakdown. The breakdown is on very low range. So what do you guys think this stock does? What do you think it does? It's breaking below a level. It closed below it, right? This is our closure. This is the break and retest. This is what we talk about every day. Okay, take all the break and retests. This is the break and retest to the downside. Is this telling us we're going to go lower? What do you guys think? Would you guys buy puts? No. It's gonna chop around. It's gonna do a whole lot of nada, right? The reason why it's gonna do a whole lot of nada is because it's on very low volume and it's not an aggressive breakout, right? Compare it to our Amazon trade. Let's go back to Amazon. Let's go back to the Amazon chart for a second. Look at the same thing on Amazon, right? Same thing on Amazon over here. High volume breakout, right? High volume breakout, large range breakout, right? Yes, it's not huge range, but the last couple of candles, this is probably about 10, 50% larger than any of the last candles, right? And the volume is considerably higher as well. Compared to this chart over here, abysmal volume, abysmal range. Even though it closed below our key tactical level, it does not look good. And that's why it just chopped around and got people stuck in the trade for 2 hours, right? And this is why we focus on price action, especially during breakouts or breakdowns. Now let's look at this chart for a second. Oops, hopefully you guys didn't see that. Now look at this chart, the same chart, right? This is the same chart, right? This is on Apple from Friday. I mean, you guys probably seen it. This is Apple 185 on Friday, right? Apple 185 on Friday. Same chart. Now we get our candle closure at 185, right? Below 185. Beautiful closure below 185. Look at the volume now. Is that high volume or low volume? High volume or low volume? High volume. Is it a large range or low range? This is a very high range, right? Very large range. The reason why I'm saying that is because look at the size of this candle breakdown with respect to the last couple of candles before the break, right? It's been abysmal all day. And then on the breakdown, we're getting a high volume sell combined with a very large range or aggressive breakdown below key tactical level. Therefore, we see, right? Let's see, can we click on continuation, right? The idea is that we want to be focusing on stocks that break out like this or break down like this and not like that. That is the most important part about today's lesson, is understanding that you can trade with key levels, but you can get chopped out all the time. And you probably will, because not every stock is going to break out the right way, right? It's not going to break out the right way. And the real winners are going to be the ones that remain patient. Now, if I were to go back to what's it called? Let's go back for a second. Let's go back for 1 second. I'll go back a couple of slides, if it allows me to do so. Okay, over here. If this breakdown occurred, if I saw this happen on Apple, what I would have done here is say, okay, wait, I like it. It's breaking below 185, right? It's breaking below 185 is my key level, right? And this could possibly lead lower, but the volume is not good and the aggression's clearly not there yet. So at this point, all I'm going to do is wait for another candle to form. If I see one more candle form below low of day, right? One more candle form below low of day, which is a high volume sell or at least a large range here, I then will go for my put entry, right? Or then we'll look for a retest or move lower. The idea is that the real traders, the ones that will have a good statistical edge, right? Over 50%, over 60%, you need to be patient in trades like this. You need to be patient. Let the trade work out, right? Let it sort of confirm itself and sell itself to you. That is the most important part about today's lesson. Now, what I want to do is I want to shift over for a second. I want to go over my last example with you. It's almost 8 o'clock. I'm going to spend maybe 5 minutes on this. I'm going over Roku. This was a very beautiful chart the last couple of weeks. And I want to just reiterate kind of many of the same things you've been talking about. So you can see here that on Roku, right, if I were to zoom in here for a second, on Roku, we have a very beautiful chart here. We have a very nice level here at 96.80, right? 96.80, which is a very key hourly resistance. It's a very strong stock. The past couple of days has been moving very strongly, with 6% the previous day. So it was a big mover, a big outperformer. And you can see it's approaching a big level here at 96.80, right? 96.80 made a high day there. It wicked down below it, couldn't break above it. And then notice the breakout, right? I don't think I need to, go back and replay this for you. And I think you guys already know what's going to happen when it breaks above high conviction breakout, or you can see here, right? This is what a beautiful breakout looks like. You have a high, obviously full body green closure, large range on very high volume over a key tactical level. Therefore, you go along with the stop below the candle low, whatever, maybe whatever your strategy says, right? And look for a push higher. But this is what I look for. We're taking breakouts, right? I want to see high volume closures, right? Big range closures over a key technical level. That is what tells me this is going to go higher or going to go lower. Again, second example here, it's 9680. The second example I have here on Roku is if you were to watch the 80 breakout. Look at the 80 breakout. This was not as picture perfect because it wasn't, you know, a break and retest that we saw here on Roku, right? But it was a very nice breakout, right, in terms of it being high volume, right? So in this case, you can see that you have a very large volume break over a key technical level, but in this case, I'm actually not convinced, right? Even though I'm seeing a high volume breakout, right? Even though I'm seeing it, the range is very small. And in this case, right, if I were to go to this chart for a second, I would, let me zoom in here. If I were to see a breakout above 80 like this, let's just say close at 80.45. Well, I wouldn't have minded to wait for one more green candle to confirm itself, right? One more green candle, then go long at 80 in a retest. And that is a lot of times what I'll do. If I see that, okay, yes, we have the volume, but hey, I don't like this or whatever reason, right? For reason A or reason B, reason C. In this case, it's because the range is not good. In this, the actual past couple of candles were huge, and this candle on the breakout was kind of just the average. So if you wanted to be patient here, you could have literally just waited, right? Waited for one more green candle to form, then gotten in the retest after getting a confirmation for a move higher. And some people would say, hey, Brett, well, look at this red candle, right? It's a red candle showing us that this is your selling pressure, right? High volume selling pressure. Well, remember, volume just equals transactions. Volume equals transactions, right? Volume equals transactions. All it's telling us, right? I'm just say trans. Hopefully I don't get canceled for transactions. They just write transactions there. Fully okay. Transactions. Volume equals transactions. In this case, right, we're having a lot of transactions occurring over 80. Even though it's a red candle, even though we have a red volume there, it's not bearish, right? It's not bearish because we're over a key technical level, right? And it would be bearish if we formed a high volume red candle that looked like this, a very, you know, obviously like a bearish pin bar. But in this case, this was not, right? This was a high volume closure above a key technical level, and you have a lot of transactions over 80, right? This is not a bearish candle. This is an indecisive candle. So understand that too. This is where I want to finish off today's lesson. I hope this was informative. I know it was a little bit of a longer one. I know I said I'd be done in 30 minutes and we're almost pushing an hour now, but I hope you guys learned something. What I want you all to take from this is that, you know, the difference between a profitable trader and an unprofitable trader is very little minute things. I'm not special. Felony's not special. Unraveler's not special. Mike is not special. Aristotle is not special, right? We're not special. We're people who just spend a lot of time in the market, you know, spend a lot of time making mistakes, just like you guys are doing. And we learn from mistakes. So that's that. You know, I take losing trades. I take losing trades all the freaking time. And you guys take losing trades all the freaking time too. It's about how you manage your risk. It's about what you do moving forward to protect your losses. And it's also about what you do to increase your win rate by reading into the charts at key moments like this. So I hope this was helpful. This was a very advanced topic. This was probably one of the most important lessons we've ever done. I kind of want to end it here. I normally would do Q&A, but I feel like I want you guys to, you know, watch the recording this again, maybe, you know, spend some time going over some charts. And if you guys have some questions, come Sunday or Monday or even later today, type in the chat and I'm happy to help you. So let's do it that way. So I'm going to end it here. Enjoy the rest of your weekend. Let me know if you guys have any questions in the chat. And yeah, hopefully this is helpful. So thanks again, everybody. And I will see you guys all